Greetings, this is Jeff Scott, and it is almost Super Bowl Sunday. It's about 11 p.m. on Saturday night, February 3rd. This is my top-down review. I titled today, The Bears Fire Shot Across the Bow, A Time to Buy or a Time to Sell. And you'll find that today I spend a lot more time on the presentation and less telling you what stocks to buy, because as you probably already get it, there's probably not a whole lot to be buying on the long side until the market declares itself. As always, this is for education purposes only. I'm a doctor, not a broker. I am independent. I do not work for any software company, software vendor, or service. I've paid for all the tools that I demonstrate, and trading involves risk, and you alone are solely responsible for any investment decisions that you make. When I do my educational programs, I always say that the goal is for you to become your own guru, and that to learn from smart folks, to pick up things and good habits, and then become your own trader based upon how you put it together. For me, it started with CanSlim, was improved by Morales and Catcher, taken to the computer by Ian Woodward and Ron Brown. George Lee, my buddy from Northwest Canada, a great trader, has taught me a lot. And then Van Tharp, Money Management. But what I really changed my results is when I started following John Person, who helped me take what was a good understanding of what to buy and really helped tone in when to buy it, how much to buy it, and when to sell it. He's an author, a mentor, a teacher, he's got some great books, and he's been very instrumental in my success. I own a lot of programs. People often joke I haven't met a software program I didn't buy for investing, but reality is I need TradeStation and Thinkorswim, as I've got different uses for the two of them, and not everything goes from one to the other. Genesis is great for futures. It's not necessary for stocks, and I know most of you don't have it, so I don't spend any time using it on these videos. HGSI is the best program I know for doing analysis aftermarket, and some in-market. EdgeRater is a great supplement to that. Yes, as evidenced by the wonderful Netflix trade, I do seasonality and a number of websites I like. HGSI, here's their website. Key parts here: free 30-day trial. Investing strategies will be lots of movies by me. And if you get this and find that you're stumped, which is not unusual, if you email me, I've got some videos that I put together some time ago that you might find useful. All right, stock patterns are cyclical. They go up, they go down, they base, and they can base for a long time. You want to be going very long during the period of markup. You want to be careful when the prices come down. I think we're in this red circle once again, and then based upon that, where we are in the cycle, I will look at different ways of trading, and as you can see, I'm much more aggressive at the beginning of a move, and when we get to this point, I get very cautious, or less aggressive is a better way. Now, the question we have is if we follow Ian's three-road scenario, and if in fact we are up here where it looks like, feels like, and seems like we're rolling over, the high road scenario is we do a very quick V reversal. Monday or Tuesday, we go up to new highs. That would be great. Probably not what I expect. The middle road will be a little bit more of a pullback, then maybe some consolidation sideways before the next uptrend. That's probably the most likely. And the low road would be that we pull all the way back to much more deeper support, perhaps around the 200-day moving averages, and then we start a rise from there. I'm going to look at the middle and the low road scenario. If we get the high road, we'll know very quickly because we'll see a reversal Monday or Tuesday. Let me make a few comments about trading on Monday. The market may gap one way or the other. The way it gaps may be a fake out. So for example, if the market gaps up, a lot of people are likely to sell into that gap, which will cause the market to go back down. it will also create, if it gaps up, perhaps a better shorting opportunity. If you wake up and the futures are down 400 points on Monday, and you start to think to yourself, oh no, here we go again, that's probably a market that's going to bottom and turn around and go back up. So, a couple of things that I've learned over the years. If the market shows me several hundred down in the futures, I will be taking off my stops. Why will I do that? Because every stop you have will be taken out, and if the market does a reversal and moves higher on the day, you'll be sitting here Monday night pissed that you got stopped out and everything went up. There is risk to that strategy, and that risk is that it'll keep going lower. The second thing is, if the market is down 300, 400, 500 points in the morning before the market opens, then you should be aware that when the market opens, you're not going to get into your Thinkorswim account or your TradeStation account, because millions of people will be trying to access so they can dump everything. I've seen in the past that I can't get into my platform. There's nothing more frustrating. So have your broker's phone number available to you so you can get in. If I see the market is down a lot on Monday morning before it opens, I will go in long before the market opens. I will take off my stops, which is dangerous, but if the market reverses, it's a good thing. And I will most likely put some really stupid buy orders in, like Netflix down 30 or 40 from where it's at, Amazon down 40 or 50 where it's at, Facebook down 20 or 30. Odds are I won't get filled on those, but I certainly saw a couple of summers ago in August, when the market did one of those days, that I got some crazy fills. And I'd rather get filled long at the low of the day than get filled and then sell at the low of the day. So just a few thoughts of how I'm going to be looking at the market. Clearly, we ended up horribly. Almost everything is a sea of red. There was weakness everywhere. I lost money, you lost money, everybody lost money if they were long. Fortunately, most of my portfolio is Amazon and Netflix, and they did fine on Friday. Although Amazon did give up a lot of its gains. Now let's take a look at the market in Thinkorswim, and let's just open this puppy up. And let's just take a look. Here's the E-minis. Now, we all feel like the earth is coming to an end, that we have to run for the hills. I lost so much money. What am I going to do? Yet you look at the E-minis, we haven't even pulled back into the 17-day simple moving average. All right. You look at the NASDAQ futures, the same thing. This is a weekly, so let me change this back to the daily. I've done that before. I should pay more attention to that, but it's going to be the same story. All right, so on the daily, again, we haven't, let's see, hold on a second. We broke through on the daily, we broke through the 17-day. We haven't pulled into the 50-day yet. When I start thinking of that middle scenario coming down to the 50, kind of like what we did right here, is the kind of thing that I wonder about. The 200-day comes into play on a more of my low road scenario. So the E-minis knife through. Another day like this, I'm below the 50. The NASDAQ futures, the exact same thing, a new sell signal on Friday, and knife through the 17 on the way to the 50. The YM futures, ditto. The IWM, the weakest of the bunch, has already closed below the 50-day moving average. The VIX, last week I think I commented on that it hadn't fallen as low as it had, and frankly that was a little strange when I saw that there was nothing to buy because the market was so extended. And you could see the VIX actually spiked up on Friday. Now it's also, we'll look at on HGSI where it's easier to see, it's also getting to the point where it's probably going to reverse in the next couple of days. The VIX doesn't stay up typically over a long period of time. High VIX, when the VIX is going up, your portfolio is going down if you're heavy to the long side. And the dollar, which had been falling, seems to have stabilized here. And will it move up further or not remains to be seen. So that's how I see the daily charts. And if I want to look at the weekly charts, which is where we started at, and fortunately I caught that before I went too far. Again, on the weekly chart, we really have had almost no damage here on the E-minis, the NQs, the YMs. Now, we don't have the TF, so let's just look at the IWM. Sorry about that. On the IWM, really, is there that much damage there? Kind of loose compared to the others. The VIX has popped up and got its head above the 200 weekly moving average, which is about the 1,000 daily. It can run up a lot higher, though, if you look back over the last year or so. It's probably about as high as it's gotten in the last year. Will we see a railroad track in reversal, or will we see a gap up or a move up and then a reversal? I expect it to reverse someday this week. I don't know when. And until it reverses, I expect your long portfolios to suffer. And the dollar on the weekly chart, that won't show up because they don't have that anymore. So let's go $DXY. I know you have the $DXY. Dollar, DXY. Hit enter. And the dollar, is it done going down? I don't think so, but maybe it runs up for a couple of weeks. So that's how I see the major markets. Let's go back into the PowerPoint. I do have some goodies for you today. And then if I look in my Genesis charts, where on the top row I got daily, then weekly, then monthly. It's no question that whether I look at the E-minis, the NQ, the the NQ, the E-minis, the NQs, the TFs, the NYSE or the YM, that there was big reversals on Friday on the daily, that we'd already seemed to have rolled over and have daily sell signals. On the weeklies, nobody's in a sell signal yet, which is interesting in Genesis, not the same in TradeStation. Yet if we look at the monthlies, we see a long monthly move up continues. Now, what's some of the background? Well, I think you're all hearing about interest rates. So if you've been watching me, you would know that I've got these two lines written over a period of time. And this was sort of the line where if we got above it, it meant the economy was strong. If the rates rose above the higher line is when I thought the market would have problems going higher. So we had a rapid move this week on the rates. Here's a 10-year, the 30-year. And that led to a market reversal. I do think the rising rates and its impact on bonds and bond surrogates like REITs and MLPs and utilities and other dividend payers and home builders, I think that was a big part of this market reversal. Strong interest rates over time will be great for banks, especially regional and insurers. Now, in white, you have the AD lines on the Russell 2000 and on the right-hand side 1000. In yellow, you have the spiders. You can see they both turned down this week. And if I look at in dark and white here in the thicker line being the NYSE AD line, and then I have a bunch of ETFs as listed up here, the diamonds, the Qs, the spiders, and the IWM. Pretty much all of them at highs and then rolled over on the last couple of days. And the bonds broke down earlier, and that's the TLT right here. So the bonds perhaps leading the market lower, and the bonds being sensitive to those rising interest rates. Now, breadth retreated. No shocker. Stocks above the 200, stocks above the 400 dropped. And this, to me, was probably the most interesting. I looked closely at this 3-month new high, new low ratio on a daily, if not weekly basis, because I know when I get up to this point up here, it's almost always a reversal. We didn't quite get there. We don't always get there, you could see. And we reversed. Now, the interesting thing is we fell so hard on Friday that we're at a point now where I expect the market to turn around. And that's based upon all these drops here. So we may have a little bit more selling, but we're getting very close to a reversal zone. The daily McClellan, I thought, wow, we got an extreme here on the McClellan oscillator. But when I look at the weeklies, we're not at an extreme. Why does the extreme matter? Because at these extremes, it's usually when the market turns up, and we're not there right now. Talk about extremes. On the left are the buckets from this past week. On Friday, and to the right, the buckets from about 3 weeks ago. So what do you notice? Sort of a mirror image opposite. And when I saw this, we were talking about the market getting at risk of a reversal to the downside. Here, with over 25% of the stocks in the S&P 1500 trading below their lower Bollinger Band, 77% below the midline, we are getting to a point where markets reverse. Now, it doesn't mean it's guaranteed. It doesn't mean it happens tomorrow. But in bull markets, I feel pretty optimistic that we're within a day or two of a reversal. Here's what happens when you're not in a bull market. There was a pretty substantial pullback in October of 2014, and you can notice that on the 1st, 9/25, the 1st of October, the 10th of October, we continue to get worse to the point where 35 to 40% of the stocks in the S&P 1500 were below the Bollinger Band. In fact, on the 10th of October, I noticed that this was in the top 0.1% of bad readings. This was 10/1/2014. Notice the number of trading days here, and the market did reverse very quickly after this post. Here's back in 2008 with the market tumult that we saw, and notice how red the pie is, meaning most of the stocks below the midline of their Bollinger Bands on the S&P 1500, and you could see almost over 40% of the stocks, over 50%, over 70% of the stocks on 10/9 were below their lower band. So although I am optimistic that we are at close to a reversal sign, in a bad market, in a bear market, that may not occur. Now, the reality is we're not in a bear market. We're either at the end of the bull or this is a correction in a bull market. And this is a chart I did for one of my live meetings a ways back. And what I basically tried to show was every time we got 25 or 30% of stocks below the lower band, we were within days of a reversal. So we'll see if we're not near a short-term bottom. Hindis, this will go in the negative column, where there have been a number of Hindis on the NYSE and on the NASDAQ over the last week. As we start to see Hindis on the march, the risk increases, although, as I've said and others have said before, most Hindis are false signals, and not all Hindis are a big drop, but considering everything may be a little bit concerning. Now, market tone, which is the Woody indicator, shifted from a bullish to a choppy with a tone that's bearish with those red spots. Sectors, several of them broke down as well on Friday. You can see the red and the yellow, no more green. Now, I have 3 different indexes that I use to give me a clue as to when this is over. And again, we've been in a prolonged uptrend, and part of my question has to be, is this a short-term pullback, minor correction before we go to higher highs, or is this the beginning of a much deeper correction and potentially a bear market? Canaries in the coal line, some of the big players of the market, the FANG stocks and a few others. We had broken out to new highs the last couple of weeks. Notice that we've pulled into the 17-day simple moving average. That is not a very bad-looking chart. That right now it's a pullback, not a massive correction. The weekly bongo is still green. We did have a MOBO breakdown on Friday, and we had a couple of negative pocket pivots and big volume. You can see the Hindis up here on the top. The Hindis that we had in October led to just a minor pullback here. But I'll tell you, if we dive below the 50 from this point, as you'll see in a few minutes, not a minor pullback. This is an index of leaders I put together at the top of the market, or what I thought might be a top of the market in the summertime. And it's also pulled back to support. As you can see, this has got a wide-based number of industry groups are represented here. Now, both of those indexes, the Canaries and the E-index, don't bother me. This one bothers me a bit more. This is what I put together a couple weeks ago. Again, the best of the best at the time on the 21st. And this one broke down hard on Friday. It kind of looks like the market itself knifing below the 17 on the way to the 50. Mobile breakdown here, a pocket pivot to the downside, and a kahuna to the downside. If this one breaks below the 50, it's over. Hopefully it provides support if it gets down there and it bounces. Know your news and your earnings. Not a big news week, perhaps, but a giant earnings week. I think I read somewhere about that one of the highest. This is one of the week with one of the highest numbers of S&P 500 stocks. Now this is good because all in all, earnings have been strong. You know, everybody's got this non-cash charge against earnings based upon the tax reform, and then in the next quarter they start raising earnings because of the tax reform. But make sure you know when your stocks have earnings. As I say in the right lower corner, it is a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Let's go back to Ian's three-road scenario. Are you bullish or are you bearish? I ran into one of the guys that follows me tonight at the hockey game, and he was bearish. I'm not sure that I'm bearish here. And I have to look at that high, middle, and low road and put some odds on it and try and figure out what I'm going to do with my portfolio or what's left, because I did sell stuff. I mean, last week I think I mentioned that I took a lot of profits. There was a reason why I took profits. And I have to tell you, I don't always tell you exactly what I think is happening. I try and help you make your own decision. But with that elevated VIX, no stocks to buy, and the high jump at 100% on all the major indexes, there's no question that this market was at risk of coming down. I don't think anybody, myself included, expected it to come down the way that it did on Friday. So here is a chart. This is from stockcharts.com. I can do this in HGSI. In fact, you'll see that chart in a few seconds. And this is sort of my secret weapon chart of helping me understand to be in or out of the market. And I'm looking at a guppy moving average chart. I'm looking at the weekly spiders, and I'm looking at 3 or 4 signals. Signal number 1, am I above the moving averages? If I'm above the moving averages, I'm still bullish. Signal number 2, are the moving averages in order from short to long, or have they inverted like a bow tie? All right, when they're lined up from short moving average to long and not crossed over, I am bullish. The third thing I look at is the MACD, is the black over the red, that's positive, but more importantly, has the MACD crossed over the 0 line? Is the MACD positive or negative? Now, these are the things that I look at on a daily basis as I try and understand what the market is doing. So here is a weekly chart back to 2007. You clearly see what happened in 2008, where you entered the bands, couldn't get out of the bands, broke down below the bands, and really didn't break above the bands until 2012. Now, actually, you broke above in 2010. You broke into the bands in 2009. And the real market took off probably in late 2011, as there was still a lot of chop in there. So when I'm above these moving averages, when the moving averages are in order by length, when my MACD is rising and above the 0 line, I'm bullish. I'm not bearish. Okay? So this will go, put one of these in the I don't think we're crashing category. Now let's look at some interesting views of this. Here is the run-up from 1996, 97, 98, 99, and we all think about, actually 99 started right here, and then 2000, 2001. And you can see from 95, or 96, 97, 98, and 99, for the most part, we stayed within the moving averages or above them. The moving averages did not flip over until late 98, and we had a very nice run-up in the market. Now, what happened here in 2001 when we finally broke through? This was the beginning of a bear market. And you notice in late 2000 when we started to break through here, and then into 2001 until sometime in 2003 when we actually broke above the moving averages, and then the moving averages flipped, did we resume a bull market. So a break below the moving averages here was associated with a pretty rough sell-off. 2006 to 2007, we had a huge roll-up. We did get into the moving averages here, but the moving averages did not turn over. And what happened here in 2007? Okay, we started getting stuck in the moving averages, and it certainly looks like a top is coming. So here we are in 2007, and then here we break through in late 2007 underneath the moving averages. Now those moving averages become a cover, and what happens to the market? The market sells off hard. Until 2009, you start to see a series of events, the first event being we moved into the moving averages in March or April, which turned out to be the end of that bear market. By July of 2009, we had broken above the moving averages, and later in 2009, the moving averages got back to the bullish pattern. So below the moving averages is bad, above the moving averages is good. What about 214 to 216? Same moving averages. Again, we stay above the moving averages. We don't break below. We stay in a bull market, although this here was a pretty deep correction in 2014. Now, 2015, we broke through, and although people think this bear market, the bull market began in March of 2009 and remains in play since 2009, I would argue that we actually ended that bull market perhaps in August of 2015 until October, November of 2015 when we resumed it. There were 2 or 3 months, and I believe this is the day I refer to, like August 24th of 2015, when everything fell hard in the market and you couldn't get into your TD Ameritrade account. And now let's go back here. We're looking at where we are today, I think, yes, where we are today, and all I've added here is the MACD. And again, going back to 2009, the MACD breaking down while we were in the moving averages was bearish. The MACD crossing up as we enter the moving averages turned out to be bullish. Where are we today? We're above the moving averages. The moving averages are nicely ordered, and the MACD is above. Doesn't look to me like a market that's in capitulation and is going to die. If you go back to the 2004, I looked at what if we just count as the bull market, we're above the moving averages. This is a daily S&P, I believe it's daily, weekly rather, and it begins when it breaks above, and it ends when it goes into the moving averages and the MACD crosses below. So when we look at it here, from 11/4 to October of 2000, the market was up 911 points, which is 100 and some percent. Then the market pulled back, and up here we broke above the MACD, but we didn't break above zero until where my arrowhead is, from November 5th, 2004 to the 11th of January in 2008. Just looking at in reaction to the moving averages, we're up 233 points, which is 19.9% in 166 periods. Then here's what I showed you with the breakdown, or here's a breakdown for 2008 and 2009. And if we don't start until 9/11, September of 2011 to August of 2015, remember in the last chart I showed you where it dived below, okay? If we look at this, we're up 730 points, or 58.8% in 200 periods. Here's where we are today. I haven't updated it, but when I looked in December or earlier in the year, we were up 33%. In 95 trading days, we're up much higher. This, to me, here, does not look like this, okay? It does not look like this. It does not look like a market that's rolling over. It looks like a market that's going higher. So what's going to change my mind? Obviously, we're at risk of having to give up about 10% to get into those moving averages. Now, those moving averages will be raising while we're dropping, so it could give up 300 points, which is a lot. I don't want to do that. But my moving averages are lined up appropriately. My MACD is rising, and it's above the zero line. I'm not ready to give up the farm here. Now, here's something we learned from Ian. If you look back over 56 years, the vast majority of corrections in the S&P 500 are less than 77%, are 77% are less than 8%. Therefore, I don't worry about the majority of corrections. Yes, I'm very concerned when I break down below 8 or 12%, because these are the ones that'll kill you or kill your portfolio. The NASDAQ, the same thing, 71% are within 8%. So the critical thing here is to not give it all up and not miss out on market gains until your corrections perhaps get beyond 8%. So I did my high, middle, and low road scenarios. I looked at several things. I looked at where we are in relationship to the 17-day, the 50-day, and the 200-day moving averages. I took the most recent touch of the 50-day moving average, and then I did Fibonacci retracements to the peak of the market, which would be back about 5 to 7 days ago. Then I tried to calculate what my risk was. So I have a worksheet that defines my high, medium, and low road. I've already told you that my high road would be that we see a reversal relatively quickly on Monday or Tuesday and go to higher highs. My middle road, I'm going to try and guess from a confluence of numbers. So if we look at the S&P 500, the high was 2872.87. We're currently at 2762.13, and we're down 3.8.5%. You would think that the world is going to end by listening to TV and people that I talk to on the phone. We're down 3.85 to 4.23% from all-time highs. We're not down that much, folks. If I look at where the moving averages are, you could see that at 2762, The 17-day simple is 2.14% off the high. The 27.15 is 5.49% off the high. And the 200-day simple is 11.85% off the high. If I look at the fib retracements, I find that the 38.2 retracement and the 50-day simple are about the same. So 27, 13, 22 on the S&P 500, to me, being the 50-day moving average and a fib retracement, is clearly my medium road target, which is only down 1.77%, and from the high is down only 5.56. My low road scenario is coming down to the 200-day moving average, which is down an additional 8.32, or a total of 11.85% from the high. So that's where I came up with what looked to be like totally reasonable projections here. There is some support here as well, but these were my medium and my low road. The high road is a reversal. I then repeated that on each of my indexes, and I come up with the medium road being down in the 5 to 7% range. So we got a little bit more to go to get there. If we hit the low road, it's as much as 14 or 15% down. As long as we keep within the medium road, we don't get below an 8% drop off. So I was watching, I think it's Robert Gaines was doing a webinar, and he talked about how rare it was to have a 4 standard deviation loss within a week of a 52-week high. He then went back since the Depression, and he highlighted the days where we had a huge deviation, 4 standard deviation loss within a week of a 52-week high. He found that a month later the average was up 2%, then 6%, then 10%, and a year later up 11%. That 1 month was positive 90% of the time, and a year was higher 80% of the time. That the risk drop, the years that it was down, are low single digits, and the risk to reward ratio heavily favors being long. Now, just because it's been this way in the past doesn't mean it's going to be the same in the future. But here's another piece of evidence that says it is likely that the market goes higher from here and not lower. So, my thoughts. We had an extreme pullback that accelerated into the weekend, bonds selling off, Russell leading indices lower. The market's spooked by rising rates yet. The economy is humming with no signs of recession. Interest rates are still low, and worldwide nothing changed in the synchronized recovery. A wall of worry persists. Thursday government shutdown vote looming once again. That's probably the big one, because I think this time the Dems aren't going to go along. Trump versus the FBI. Now, I thought the FBI worked for the president. I don't think I've ever seen the president and the FBI at war before. And interestingly, North Korea is actually quieting down as we approach the Winter Olympics. It was so heartening to see North and South Korean skiers practicing together in North Korea. Personally, I need to follow Ian's rules and prepare for 3 separate roads. The high road says we quickly see a V-shaped recovery. We should know that in a day or two. And again, when I look at the weekly bongo still being green, I look at the moving average charts that I showed you, the MACDs. I looked at my risks. I looked at that Robert Gaines chart. I think the high road can happen. If that happens, we'll know right away. The middle road means we pull back to support, and we probably go sideways for a while. What that tells me is I'm going to make sure that I'm not sitting on a lot of February options, because if I have to get them higher to make up for some of the losses on Friday, I may not have time left. So I'm going to have to look at what I'm going to do with those. And the low road scenario, I'm going to get stopped out eventually of all my positions. Although, as I said, if I see the market to open up 400 or 500 points down, I want to be out of my stops and then manually manage those stocks, because if we open up that far down, we're going to close higher. Now, that was a long time. I think, frankly, nothing else matters. It's all about the market, not about stocks, industry groups, and stocks. A few comments on the charts, and then we'll say goodnight. As you know, I like to go into TradeStation, so here's what happened in TradeStation. We broke down this Thursday, Thursday, Wednesday, Tuesday. We had a new sell signal. We went from green to blues. Remember, we look at the person sell or buy signals. We look at daily, weekly, and monthly. The weekly and monthly are still in a buy signal. We look at the color of the paint bar. We know that if it's green, I should be buying or holding. If it's red, I can be shorting or holding. If it's blue, I can do whatever I want. So we've got sell in a red bar, buy in a blue bar, buy in a blue bar. So clearly has weakened. We look at where we are within the envelope, and as I sounded like I was wrong and kept saying we don't last outside the envelope for this long without a correction, well, we're no longer outside, except we still are above on the weekly. I like to look at my high jump, and when we were up here at 100%, I said we were at high risk of coming down. Now we're at 30%. The pressure is off, and the weekly bongo somehow is still green. So the E-minis, short-term weakness, doesn't look to me like it's over yet. We'll be watching some of the longer-term charts. The NASDAQ 100, similar pattern, sell signal in red, back within the envelope, still above the envelope on a buy in the weekly and monthly, 38% on the high jump, bongo is green. The YMs kind of look a lot like the E-minis, breaking down. Above the envelope, 30%. Now, if we sell off hard on Monday or Tuesday and get below the envelope, I'll be looking for my MACD divergence dots to turn green on the bottom and give me a sign that we're going to rebound. And then the weakest of the bunch, as I mentioned earlier, is the Russell. And you can see the Russell is getting down near the bottom of the lower envelope. It too went red on the weekly and a weekly sell, and the weekly bongo is red. The dollar looks stabilizing here. It's got the green MACD divergence or convergence dots on the weekly and on the daily. Looks like it at least is done going down for now. The VIX, as we talked about earlier, is spiking. Buy signal in green, buy signal in green, buy signal in green. Weekly bongo is green. High jump is 100% though. So maybe it's already getting extended. That would be great for the markets. And then the yellow metal gold, YG here, with the dollar strengthening, or you can see gold has weakened some, at least on the short term. All right, so markets under pressure. Then I'll go into HGSI very quickly and go into the Woodward & Brown user groups, Major Markets Plus, hit Warehouse, do top-down view. And what do I see? I see the strongest indexes, volatility, then commodities, utilities. That's a very defensive looking. That's bad for the bulls. Gold, interestingly, on the bottom, as are most of the indexes. Then I open up the S&P 500 and just go back up here. And this is what I was working with earlier today and doing the fibs, etc. But just looking at this very quickly, I see that the weekly bongo is green. Here are the Hindis that came in. Let me point something out to everybody on the board who uses HGSI. I am using the HGSI All NYSE Index. Something changed in the last couple of years that if you're using the bar charts, you may not see them. You can, however, add a second indicator to the same window, and I'm going to pick the Hindenburg Omen again. And I'm going to put this time on bar charts. And so now I've got them both in there. And so now I don't miss them when they happen. So I would put both indexes in there, so both calculations. So how many times have I told you on these webinars, I can't find the one I wrote on it, that we are getting extended off that 50 and that I would expect us to come down and visit the 50. And I still do, and a pullback to the 50 looks like it's all of 5.2% from the high, where a pullback down to that 200 would be more like an 11.4. I think a pullback to the 50, which is my medium road scenario, would be healthy. Sideways consolidation before the next leg up would be awesome. The Dow Jones Industrial, those 30 stocks, similar pattern heading down towards the 50. The NASDAQ, as I've already showed it to you in other charting platforms, should be the same. Heading towards the 50. Notice on all of these, the weekly bongo has stayed green. The Russell futures, or the Russell ETF, the weakest. Now, this is the one that might bounce first. Or goes back down another 7%. That's not correct. Let me try that again. That's not what I want either. Down to the 200-day moving average from here. Come on. I don't know why it's doing that. Last time. From the close, that would be another 5.5%. Certainly not that far. The dollar we looked at earlier, just to show you again, in HGSI, same thing. Kind of looks like it's bottoming here. PSAR reversed. The forces turned positive, had a pocket pivot on big volume. Dollar looks like it's firming, at least on the short time. Volatility bounced up here. It's at a point where it reverses. The higher this goes, the more your portfolio will suffer. When it reverses, it'll be a nice time to go back into the market. And then we showed you gold was weakening. It's miners. You know, it's right in front of my face, which makes it hard for me to see it. And you could see gold gave up some. Not surprising with the dollar firming. And silver looked a little bit worse. Breaking down here looks a lot worse. Local breakdown, pocket pivot, kahuna to the downside, and the weekly bongo turned red. Silver looks pretty weak. So if you haven't gotten my cautious tint yet, let's take a look at the index groups. There's 7 of them. Excuse me, there's 170 of them. If I look at 2-day force up, you'll find 2 made it. I can't remember the last time that only 2 groups were moving to the upside. That is how much power the market had to the downside on Thursday and Friday. If I right-click, change to index group, I see 2 of them were above the index. Let's quickly look at them and see if there's anything we'd want to buy. Quinn Street average volume is a little bit less than 500. Did have a buyable gap up. It's a media stock. It has earnings per share growth, no dividend. I don't buy things with that little volume, so I probably would not be buying it. I did, and then Aquantia, even less volume. So probably for me, not much interest there. And then cable and satellite. You know, Charter looks interesting here to me. It doesn't pay a dividend. It's got accelerating earnings. You can see the number of pocket pivots. It had a kahuna come in on a very bad day in a mobile breakout, and everything is green up above. I do like Charter Communications. That's it to the upside in groups. I've never been so fast to get through that. If I look at 2-day down, you could see that there's not that many short-term to the down, but a lot of the usual groups that we see. Internet media, Weibo, one of the holdings I've had, sold off hard on Friday, probably pulling back to its 50-day moving average. Twitter gave up a little bit. YY sold off. Integrated oils, oil and gas services, precious metals, base metals, MLPs, banks. Interesting to see banks here, especially since they're big winners from the reduction regulations and the raising interest rates. The one I actually liked to the long side was Regions Finance. It's right off its highs. It did have a red candle high on Friday, which is bothersome. It's got good earnings per share growth and pays a small dividend. Casinos turn lower, airlines, beverages, aircraft, including Boeing, wealth management, life insurance. All in all, it was a lousy day. On the 5-day force down, you can see 88 of the 170 are in a little bit longer corrections. And on the 5-day force up, again, only 2 groups, advertising, cable, satellite, are positive. So Thursday and Friday were so rough, they pulled this whole market into a correction. Now, how I play, if I wanted to go long or go short right now, I can look at individual to the short side equities, and I did. And some of the stocks I like to short, these are some of them that came up on my scans. So I'll just look at these and comment on them. The thing to point out is I'd rather short or go long contra ETFs and buy puts than go short the stocks. Adobe looks like it's rolling over here, had a mobile breakdown, a pocket pivot to the downside. Good earnings per share growth, but slowing down. When I looked at MarketSmith, PSAR is above price, which is bearish. Avalon Bays, it's a REIT. It's breaking down. It's an expensive stock. It did bounce a little bit on Friday. I'd love to see it pull up into the 17, which would be a great place to short. Broadcom, it looks like it's breaking down. Again, I'd like to see it run back up before I shorted it. Costco, hard to believe I even talk about that, but I'm looking for it to break below the 50. Cummins, in again, another stock that looks like it's rolling over. You know, it's hard for me to short these because most of these stocks were extended 5 days ago, and you know, I still think we're going to see another leg up. Here's Deere, another big winner that looks like it's rolling over. So one way to play the short side, if you think the market's going to go short, would be to look at some of the bearish ETFs. So I want to just very quickly go into, let's see if I can find them here, 3X, long and short. So actually I know what they all are by heart. So here are some of the things that I'll be looking at. If I think that small stocks are going lower, I am going to look at shorting or at buying the TZA. So the contra ETFs go up when the market is going down. These are tied to small caps, 3 times the movement. Clearly been in a horrible downtrend for quite some time, but it looks like it's bottomed. A break above the 50 I think would be bullish. Notice the weekly bongo has gone green. You got a pocket pivot, you have a kahuna. So if you believe small caps are going down, you can buy TZA. It acts like a long, but it really is a short in that it goes up when the market goes down in huge volume. If you think that the Qs or the NASDAQ 100 is going to fall, then you could buy a couple of different things. You could buy the QID, which is the ultra short triple Qs, and like the TZA, this will go up if the Qs go down. All right. So notice too, it's still got the 50-day in front of it, but it had pocket pivots, kahunas, and a mobile breakout. Its weekly bongo is still red. If you are believing that financials, this is the long financial ETF, it looks like it's rolling over. If you want to play financials to the short side, you can buy FAZ, a kahuna, and an up move on FAZ. So those are some of the ways that you could play. If you think that you are long biotech, then you're buying LABU. If you're concerned about biotech and you think biotech is going down, you can buy LABD, which hasn't started to move yet. So there exist ETFs that will be inverse to the types of things that you might be looking at to buy long. I like the direction. It's important that you check the volumes on some of these. If you so you have gold, you've got energy, you've got S&P 500 bull or bear. So it looks like the SP 500 is going to fall. So this is the long, all right? But what if we buy the short ETF? So this goes up when the market goes down, SPXS. And if the market falls, this will go higher. Most, but not all, IRAs will allow you to buy contra ETFs. So again, the contra ETFs are instruments that go up when the corresponding market goes down. If it's called a bull, then it goes up when the market goes up. If it's a bear, it goes up when the market goes down. So you can play individual countries, sectors, indices, even industry groups through some of the different ETFs. And that's how I like to play the short side, because I can put some options on them, get tons of leverage, and play short moves for a lot of money. I would be learning about ETFs and then making your own decisions on the market. Now, what about going in and buying? Well, volatility is up. I definitely want to go in. I say definitely, I'm being facetious. I want to buy VXX. And there's no question that VXX looks like it popped this week. Here's the problem with VXX. It is destined to go down. You can make money on VXX, but you have to make money over very short periods of time, 3 or 4 days. Does it look like VXX is going higher? Absolutely. A mobile breakout, a break above the 50, a kahuna, and so on and so forth. But these are sucker bets. So if you think it's going to break out and run up to 45, you take it. But these are short-term trades, not investments. Same thing with things like UVXY. And TVIX, which are some of the leveraged VIX instruments. I like to play SVXY. It's a $100 instrument, and it is inverse to the VIX. So when the VIX goes up, it comes down. And one of my favorite ways to play is to short this. And it's one way of profiting on the volatility. We'll see. A bingo coming in tells you baby's out with the bathwater, another sign that market might be getting ready to reverse. So I'm not spending any time on sectors and stocks today because there's just not that kind of a market. I did go through and I looked at stocks to buy, and most of them, frankly, will be like Freeport-McMoRan. It is definitely not time to buy Freeport-McMoRan, but it's pulling into that 50-day moving average. And if I'm right and we get a reversal quickly, then I would expect it to pull into the 50 and reverse. So I built a watch list of some of the stocks that I liked that are searching for support. So Exelixis Tech sitting on the 200, Centene heading down, it's on the 50, Dollar Tree pulled back to the 50, Floor & Decor sitting on the 50, Freeport-McMoRan almost there, Gardner Denver 50, Marathon Petroleum, Mellanox, SCI Investments, Westlake Chemicals. What are the stocks I like to buy? Uptrends, pull back to the 50, move up on momentum. All I need is the momentum. So much of this list are stocks that are pulling back. If I had to pick one to buy, I showed you Charter. Let me show you one other, and then I'm going to say goodbye. This is Excel Company. Remember I told you if interest rates go up, there's a couple kinds of companies that benefit, and one of them is insurers. So here is an insurer. Let's look at a weekly chart. Kind of been going nowhere, sitting on the major support, the 200 weekly or 1,000-day daily moving average. It's moved up a couple of days here, lots of pocket pivots, a Kahuna Mobile breakout. The weekly bongo went green. What got me interested is the earnings are starting to accelerate in the stock, pays a dividend, lots of shares traded. So I'm going to be looking at this one. It's not a classical growth stock by any means, but none of those are working right now. So in summary, you need to figure out your own three-road scenario, and then you need to be prepared for it. You need to know in advance what you're going to do. It is possible that I'm wrong and we blow right through and go the low road scenario and get a 20% correction. If you trade growth stocks, you will be hammered. As an example, this was a lousy week for me. I'm sure it was a lousy week for you if you had long positions. Now, fortunately, I've been up a lot on the year. I gave up a little bit, took a little heat, but I'm still pretty happy on the year, extremely happy. Here's how the week looked. So this is looking at trades from 126 to 22, $1,000 per investment. Ignore the first two because there were no stocks there. Every group that I track was negative. The Market Smith 250 was minus 4.544. The weekend review was minus 510. The IBD 50 was minus 510. My buy watch, which I didn't buy many of them or any of them, was minus 6%. My holdings were minus 3.3. My trilogy buys 3.11 to the downside. S&P 500 3.85. Not a great week for growth. I did outperform the market as a whole, but it was a tough week for everybody involved. So on that note, be careful. Taking your stops off is not for everybody, and let me just reiterate my point. If you see the market's going to go down 500 points at the open, your stops will be filled, but they won't be filled at your price. They'll probably turn into a market order when they're hit, and you'll get filled way below where they closed on Friday. If the market continues to go down 1,000 or 2,000 points tomorrow, then you'll be pissed if you take off your stops. But if the market opens up Monday 300, 400, 500 points lower, and then it reverses, which would not surprise me, do you really want your stops to be on? So I have taken off my stops. Let me back up. I plan on taking off my stops or some of my stops if I see the market is going to gap down on Monday. I am also recognizing that if it's down 300 to 500 points before it opens, that it's maybe tough to get into your platform, and I'm going to stick some crazy lowball buys out there, which I've had filled in the past. It's going to be an interesting week. We will reverse to the upside. The question is when. Most days are not like Friday, and most pullbacks are not like the Great Depression or the depression of our lifetime, 07, 08, 09. Most pullbacks are less than 8%, and getting pullbacks of smaller magnitude and sideways consolidations in the long term may be very healthy. On that note, I'm going to say goodbye. Go, I can't say Patriots because my wife's an Eagles fan, but I'm a Tom Brady fan. So y'all have a great weekend, and we'll talk to you.